is that people need to understand that fiat and debt are one of the same. Debt is just postponed in the future fiat to be owed or paid, which has a little rental payment on it, which we call interest. So it's all about the borrowed into the existence money. Now, we've created the sense that they are separated, and I call them the Siamese twins, conjoined at the head, because you can't debase one without debasing the other. You can't drown one without drowning the other, if you'll forgive the metaphor, because they are synonymous. One is money today, and one is money in the future, for which you're paying a rental state a payment, a maintenance fee, if you like. So all of this leads to higher gold.
Francishunt explains that fiat currency and debt are essentially the same, with debt being postponed fiat, borrowed from the future, and repaid with interest. He describes them as Siamese twins conjoined at the head, emphasizing that one cannot be debased without affecting the other. This connection reveals how modern economies are built on expanding credit and borrowed money rather than true value. Hunt argues that the illusion of separating fiat and debt sustains a fragile system. When governments expand debt, they simultaneously inflate currency, eroding purchasing power. The entire economy operates on borrowed time, relying on artificial money creation to maintain growth and stability. Ultimately, Hunt concludes that this system naturally drives gold prices higher. As confidence in fiat erodes, investors turn to gold, the only asset immune to monetary debasement. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely REIN updates.
This is the US 10-year, by the way, that we're looking at. Let me make it a tiny bit bigger on the chart so it can show nice and big. And this was part and parcel of our 2020 call that technically you had had a final capitulation in rates of lows on the events of CV19. So that's this over here. Let's make sure we've got our draw tool engaged there, that moment over here. And just to remind people that are new to bond markets, which this is the US 10-year debt instrument, if I go up to monthly, you can see how long a trend this was. This was 40 years of lowering rates. 40 years of lowering rates, this is log scale, and that was a huge capitulation in rates, which was a massive surge in bond strength during the huge fear that was generated by the events of 2019. So when I take you back into this chart, that is a trend change for us, and you should be looking for higher rates, not lower rates on the big time frames. So whilst we have had a bit of chop and churn recently, we've come very close to severe technical levels. It's our overarching expectation that in due course, you will break out to the upside here on the US 10-year, which is where the housing market is priced for available debt. And everybody debt finances in the States, as you know, on just about everything. 5.97 is our target. You're currently at just above 4s. And what was really interesting is, despite all this chat about rate cuts and everybody becoming, oh, the economy is so weak, they first were transitory inflation. We were saying it's not transitory, it's much worse than you think. When they hit recession a number of years ago, this was still Biden-Yellen era. We said it is a recession because that's the definition of one. And they said, no, the labor market's still so strong. They added a new criteria only for that labor market metrics to be totally revised countless times, monthly, annually, and eventually now during the Trump epoch, they've literally stripped out millions of jobs that were falsely stated. So you've been bouncing in and out of a recession, I think, for a while now. And GDP is a flawed number. But at the same time, you've got such fiat debasement, which is why the gold was moving so quickly, that you've also had this inflation. So the interesting part is this has bounced at the 4 and started a little bit of a turn up. And that's in spite of the fact now that they are talking and there is still expectation for a December cut. They actually want to debase debt because the one bubble we need to understand in all of this is that the biggest bubble is, in fact, fiat debt. And I want to it's something I've started saying a lot more, is that people need to understand that fiat and debt are one of the same. Debt is just postponed in the future fiat to be owed or paid, which has a little rental payment on it, which we call interest. So it's all about the borrowed into the existence money. Now, we've created the sense that they are separated, and I call them the Siamese twins, conjoined at the head. Because you can't debase one without debasing the other. You can't drown one without drowning the other, if you'll forgive the metaphor, because they are synonymous. One is money today and one is money in the future for which you're paying a rental state payment, a maintenance fee, if you like. So all of this leads to higher gold. All of this, significantly higher gold. The other things to highlight that are fundamental while we jump on the charts here is with the gold is that you will not have made a top in gold for me with the gold silver ratio in the 80s. That just hasn't happened, especially with the shortages in silver and platinum, very thin markets, and very concerning supply constraints on silver. We're just at stage one where we've started to go fast and we've had a bit of a pushback. I just did a few let me just bring in these corrections that you've had so far on the weekly chart. It's a little congested here. That's 10.26 that you pulled back so far. You had a 10.8 over here. These are all pullbacks. I should maybe do it on the 3-day. It's a bit tightly packed. You can see we were 2,536, the low for the last 12 months, and we had a 9% correction there. You've had 4%, 4%, 6%, 10%, 6%. You're going to keep having these kind of corrections all the way to 10,000 and beyond. Yeah. So it really is keep calm and carry on in terms of all of this. For the technicals, that's like what happened in the charts. Well, you have to drop to smaller time frames to see a little bit of this. And in our community, we were discussing that. And you could see that there was a double top here. We got quite a violent slam on this time frame. It's only on this time frame. It's not macro significant. And you've got to rally back up to the same level. That's a double top. It's like an M figure like that. That generates a target. That target was made on that wick. And then with inverted HVF, we saw that there would be a further dip down. So we were saying, don't buy in yet, friends, because we only trade to the long side, even though we saw the short setups in here. I'll show you this as well. And I might just drop it to a 2-hourly. That is the last bit of price behavior. We said, yes, look, another squeeze is set up. That's an inverted HVF. It's a continuation pattern further downside. That means you have another target to make, which, of course, you have made to the downside. And what's actually happened now is you've started to get some rallies. They're on holding on that. There's still some firm selling. But eventually, if they continue like this, one of two things will happen. We haven't called the bottom yet, but the momentum sell-off was highest over here. We haven't had this level of momentum sell-off since. This is more a gradient down. And the minute it started to capitulate, the buyers came in. You see a little bit of an acceleration there. Boom, you made the target, and then buyers came in. So there's a lot of money that's quite prepared. This was, again, the momentum was still a little firm to the downside and a bit grindy to the upside. So what could happen here, for those wondering what happens next, is that you could get another flag rally and another reasonably firm sell-off here. And you'll end up setting up potentially another one of these, which is like that. 1, 2, 3, which we call the HVF setup. And that is a squeeze. It's 3. It's a tightening of the volatility, something quite flat bottom like that, down, and a small bounce with a flag. And you'd probably, if this is the bear scenario, it's not only a bear scenario. I'm not calling this as my base case, but if it does that, technical traders that are short term who like to trade in any direction could short here. Or if you're a hedger and you already hold and you'd like to hedge a little bit more downside, you could sell short with us, technically trading this against your holdings. Take your target on the downside, use any profits to buy more bullion, which will at some point be going up. The point I'll make here is these patterns are also getting smaller. I'm on a 2-hour time frame now.
Francishunt, widely known as the market sniper, highlights a crucial turning point in the US 10-year yield, marking the end of a 40-year downtrend in interest rates. He explains that the final capitulation during the 2020 COVID-19 crisis signaled the close of the cheap money era and the beginning of a structural rise in yields. Despite market hopes for rate cuts and soft landing narratives, Hunt believes higher rates are inevitable as the global debt system built on fiat expansion, reaches its breaking point. In his broader outlook, Francishunt links this shift directly to gold's long-term strength. He calls fiat and debt Siamese twins, inseparable in their debasement. As trust in fiat currencies erodes, gold will inevitably gain value. Despite short-term corrections, Hunt remains confident that gold's journey toward much higher prices has only just begun.
That was broadening structure. That's a megaphone, and that's an ascending broadening structure. You can see why I call it ascending, because we have what's called a splitter. This is unique to HVF method theory. You won't find it anywhere else. That's why we're powerful technicians. And when you have a bull pole with an ascending megaphone, it's tapping out. If it's descending, it's continuation. And then once you get a little bit more information, you see, well, we kind of had a flag there, and we'd already had a sell off there. The round number that is quite clearly a neckline for us is $50.65. And then you can identify subsequently. So patterns further confirm each other rather than contradict each other when you're doing it correctly. So you could have shorted the flag. Again, I don't short silver in bull markets at all. It's not my game. But technically, you could have shorted there with a very tight stop there. You would have been triggered into the head and shoulder there. You would have had the head and shoulder target right the way down there, which you eventually made as well. And you would have taken out the 50 round number. We've also put that in, which is quite an interesting level. And gold at its 4,000, you kind of got silver, not quite 50, but it's 49s, going for 49s and back into that 50 range. When we met you, we did warn. And I want to just say the following as well, for anybody who's feeling a bit intimidated by the recent price action. You're watching it on too low a time frame. We said, when you get to the 50 level, which had been resisted, and we used our standard catchphrase that you'll remember if you watch the previous video. I'm sort of leaning, I wasn't a Lionel Richie fan, but he got played so often. It's once, twice, three times, and then a lady. You can see I have a small shooting star there. We'll leave the lovely Dutch orange behind for a second, and we'll go back to our transgender pink. And there you go. Small shooting star, which is a rejection. So, you could tap out, have a little hammer, and that could be it. Or it could dip a little longer. But again, this is an incredibly bullish structure. So it's the fourth time that you get your huge move for silver runners. You needed to make the third visit to the $50 range and get rejected. Watch the previous video when we were with you. We would have highlighted this when we covered silver. Now, why we say this is an ascending HVF, not a cup and handle, or it is both, but why the one is far more powerful than the other. We, with our drawing tool, generate real live targets. And you've seen how our targets work on the smaller time frame. They're more reliable on bigger time frames. And they've already shown themselves to be exceedingly reliable on what we've just shown you now. So that is an upside on a log scale chart. And this is one of the biggest structures. It is actually the biggest structure I'll ever trade in my entire trading career. And I've been in the trading space for a very, very long time. And the bigger the time frame, the more the reliability. But what people forget is when you're on a quarterly chart like this, you really need to set and forget and relax. Most people's time frame, they're wired too quick. They jump in, they jump out and all of it. You're best served by just being net long. Now, that's an investor in many instances, but you can actually leverage trade this. So for us, you triggered this pattern quite some time ago. It was July in 24, I think it was, or 23. When you ran that 23, and you've made our first target, and we normally get a little bit of a pullback after you've run there. That's what's potentially going. The best phase is yet to come, though, and it doesn't look like much because I've got it on a log scale, but your next interim target is $90, nearly $91. And again, I'm going to just take it off log scale for a while so that people realize what kind of a call that is we're making. We're not shy. You're not getting easy calls here. You're getting massive calls. When this is done, possibly pulling back. Hey, it could come all the way back and rest on the first target. It's often a key level, or it's nearly done now and might just have a short pullback and a little final dip down. It could technically even come back to our green line. It's not always does that, but we call that a return move. With the shortages and fundamentals, I think that's going to be hard. But maybe if we have a huge financial crisis, a demand-destroying event, and banks have been aced and there's nobody building anything, solar panels aren't made, no one's buying, we really stopped the clock on the economy, kind of like what we'd tried before in March 2020, then you could quite well have a pullback all the way to 30. It's not a call that I'm making, but the next move is this move. Whatever it does to the downside, let's say it does that, it's running to the doorstep of 3 digits as part of its next major move. But remember, each candle is 3 months. It doesn't mean tomorrow it's doing that or next week necessarily. This could take 3, 4, 5, 6 weeks. It could take till the end of the year to happen on a pullback. It might not. It might be 3 days. I can't answer that. How long is that piece of string? I can't tell you. But if you're staying in for the long run, the next time you have a major significant pause will be in this level. You may have technically just run 100 and done 101, 103 and been smacked down, a little bit of Mr. Slammy action, or you would have balked at the 100 and you'll be sitting in the mid-90s winding up for that key psychological level to go higher. But I can tell you, this is, we're at 80, this still is the buy, the cheap buy.
The silver market is forming one of the most powerful long-term bullish structures ever observed, an ascending, broadening megaphone that signals an eventual explosive upside. The $50 level has proven to be a historic resistance, tested multiple times, each rejection, with patterns like the flag, head and shoulders, and HVF confirming each other. The technical structure remains undeniably strong. Could this be the final setup before silver surges toward its next psychological milestone near $100? Despite temporary pullbacks or corrections, the broader trajectory remains intact, supported by structural shortages and strong industrial demand. Each candle on the quarterly chart reminds investors that patience is key. Silver's most significant move is yet to unfold, turning today's consolidation into tomorrow's opportunity. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest Forbes updates. Thanks for watching.